In this video, we continue our discussion on Chapter 10, in which we go over the profit maximization process for a monopoly, where in our last video we defined the monopoly market structure and examined its characteristics, where today we will use that information in order to go over the profit maximization process for a monopolist, and we will do so by going over some preliminaries in order to construct marginal cost as well as marginal revenue for a monopolist, and then conclude with the profit maximization process itself, where, beginning with our preliminaries, in order to work through the profit maximization process for a monopolist, we will need two items. The first being the firm problem, in that firms maximize profits subject to the production constraints, where this allows us to see how firms produce goods and services using their factors of production, as well as how they incur costs, generate revenue, and price their goods or services. But we cannot explicitly calculate the pricing strategy without a market assumption, which is precisely our second item, in that we need the market structure, where in this case we're assuming a monopoly, where we have seen that means there's a single firm operating in the space whom is a profit maximizer and which high barriers to entry to exist, such that other firms cannot enter in the market to compete. Additionally, in terms of goods and services, there's no close substitutes available in terms of comparing to what the monopolist is producing. And lastly, the monopolist is a price maker in that they have the ability to alter the price of the good or service. So then, with our two necessary components considered, we will go through the profit maximization process similar to that of what we did with the competitive firm, in that a firm produces a good or service using their factors of production. When the firm produces the good or service, costs are incurred from input resources. When a firm sells the good or service, revenue is generated from the sale. A firm then compares additional revenue from the sale to the additional cost from additional production, such that in the profit maximization process, a firm considers marginal revenue and marginal cost, and they compare the two since they are making a marginal production decision. So then, with this information, let us proceed by example then. Suppose that we have a sole electricity provider in the area that is sanctioned by the government, where this sanctioning from the government acts as our high barrier to entry, in which this electricity provider generates electricity in terms of kilowatt hours using a fixed amount of capital and a variable amount of labor. So this also translates to looking at a short-run production function, which we have below. In our production function, capital is fixed. We have a variable amount of labor, which is on the horizontal axis, and in this case it's going to be in percentage terms. Labor can be from 0% to 100% of the labor force, and they use that to produce electricity in kilowatt hours, which is going to be on our vertical axis. And in terms of production, our standard assumptions hold, in that as more variable labor is used, production of electricity is going to increase, but at a decreasing rate due to diminishing marginal returns on labor. And so with this in mind, to proceed, we now need to know how cost and revenue change. So, beginning with our cost structure, for costs, suppose that there are fixed payments on capital of 25 cents, and the labor force is paid a wage rate of $5 if used in its entirety. Using this, we can construct our fixed and variable costs and then construct our total cost structure as a result. So our fixed costs are going to be our costs on capital, which are going to be the 25 cents, and which will not vary with labor and output being used and produced. From which we then have our variable cost, which is going to be the wage rate paid to our employees, which is going to be $5 scaled by the percentage of our labor force that's being used, which will be anywhere from $5 scaled by 0% of our labor to $5 scaled to 100% of our labor, corresponding to the full $5. So then that's precisely what we have in terms of variable cost. It ranges from $0 to $5 depending on our percentage of labor that's used, corresponding to a different amount of output being produced. And then total cost is going to be the sum of our fixed and variable costs, which is going to be a minimum of 25 cents when zero output is being produced, given our fixed cost, and is going to be increasing all the way up to $5.25 when 100% of our labor force is being used to produce 5 kilowatt hours of electricity. And as a result, we have our graphical representation on the left, cost on the vertical, output on the horizontal, and we have our upward sloping total cost curve as a result, upward sloping due to variable costs, non-zero when zero output is being produced due to our fixed costs. So then with that cost structure, we then want to find its rate of change, or its slope, or marginal cost. That is, if production changes by 1 unit, what is the corresponding effect on total cost? So to calculate the slope of the total cost function, we'll need total cost on the left, and we'll need to find its rate of change, which we'll use our table representation in the middle, in order to calculate our marginal cost curve on the right. So this is going from point A to B, B to C, C to D, D to E, and E to F. Where we see going from point A to B, this is output changing from 0 to 1 units, and total cost is going from 25 cents to 75 cents, or that to produce that first unit of electricity, 50 cents of additional costs are incurred, which corresponds to point B on our curve. Going from 1 unit to 2 units of electricity produced, total cost is going from 75 cents to $1.50, or that cost is changing by 75 cents for that second unit of electricity, which generates point C. Going from 2 units of electricity to 3 units, we see that total cost is going from $1.50 to $2.50, or that the rate of change in terms of costs is $1, which generates point D in terms of our marginal cost curve. And going from 3 units to 4 units of electricity, total cost is changing from $2.50 to $3.75, or there is a change of $1.25, which generates point E. And lastly, going from 4 units to 5 units of electricity, we see that total cost is changing from $3.75 to $5.25, or that cost is changing by $1.50, which generates point F. Work together, we see that this generates our marginal cost curve, which we see is positive, upward sloping, and in this case is increasing at the constant rate of 25 cents. Where the important thing to note is that it's upward sloping, once again due to diminishing marginal returns on labor. So then with our cost structure considered, let us now turn to our revenue structure, which is going to differ from what we saw in the competitive sense. In that since the electricity company is a monopolist, they have market power and they are the sole firm in the space. Being the sole firm in the space, they can look to the market demand curve in terms of their pricing strategy. As a result, they will consider the market demand curve, which we have precisely that below, where price is on the vertical axis, electricity in terms of kilowatt hours is on the horizontal axis. We have our downward sloping market demand curve due to the inverse relationship between price and quantity demanded. And in terms of calculating revenue, this is going to be the matter of scaling price by quantity in terms of what we see on the demand curve in the market, where this is going to be price times quantity in terms of each points from B to F, where we see that total revenue is increasing from points B to D and then begins decreasing from points D to F. So then with this information, what we'd like to do then is then find the rate of change of our revenue function in the form of marginal revenue. That is, if output sold changes by 1 unit, what is the corresponding effect on total revenue? To find this, we need the slope of our revenue function, in which we'll consider our market demand curve on the left. We'll calculate the rate of change using our table representation in the middle, and then generate our marginal revenue curve on the right. So going from 1 unit of electricity sold to 2, we see that total revenue is going from $5 to $8 in terms of total revenue, or that there's a change of 3, which generates point C on our marginal revenue curve. Going from 2 units sold to 3 units sold, we see total revenue is going from 8 to 9, or there's a change of positive 1, which we see generates point D on our marginal revenue curve. And going from 3 units sold to 4 units sold, we see that total revenue is going from 9 to 8, or that it's decreasing by -1, which generates point E. And then lastly, going from 4 units of electricity sold to 5 units sold, total revenue is changing from $8 to $5, or there's a change in total revenue of $3, which generates point F. Where the two things to keep in mind with the marginal revenue function for the monopolist is that it's downward sloping, and we see that it's strictly below our market demand curve for electricity. So then, with our information in terms of marginal cost and marginal revenue for the electricity provider, let us put the two together and go through our profit maximization process to find our production decision that maximizes profits. So here we have our profit maximization process, in which price is on the vertical axis, quantity of electricity in kilowatt hours is on the horizontal axis. We have our upward sloping marginal cost curve in black, our downward sloping market demand curve for electricity in blue, and then we have our downward sloping marginal revenue curve in green that is below our market demand curve. In terms of profit maximization, we know that this occurs when marginal cost is equal to marginal revenue, but let us work through our cases for when marginal revenue is also greater than marginal cost and less than marginal cost. From points B up until we get to point D, we see that marginal revenue is strictly above our marginal cost curve, or that marginal revenue is greater than marginal cost. At this point, in terms of our production decision to use more labor to produce additional electricity in terms of kilowatt hours, money flowing into the company is greater than money flowing out of the company, so this would be worthwhile for the company to do, as we expect when marginal revenue is greater than marginal cost. Where at point D, marginal revenue is equal to marginal cost, at which point using additional amounts of labor to produce additional amounts of electricity corresponds to the amount of money flowing into the company equaling the amount of money flowing out of the company with this decision. Where afterwards from point D all the way down to point F, we then see there's a change in that marginal cost is now above the marginal revenue curve, and that marginal cost is greater than marginal revenue, where using additional labor to produce additional electricity in kilowatt hours, the amount of money flowing out of the company is greater than the amount of money flowing into the company, such that this would not be a worthwhile decision. Therefore, marginal cost equal to marginal revenue is where we would like to produce, given that we have no further incentive to produce and we have no further incentive to cut back in terms of our production. So then with our output level determined at point D corresponding to 3 units of output, since the monopolist has control over the price of their good or service, that is, they are a price maker, and they use the market demand curve in terms of their pricing decision, we use this output level to then move up to point D on the market demand curve and then see what households are willing and able to pay at the quantity level of D, where in this case this corresponds to a price point of 3. So then what's going on in terms of our table representation? Profits are maximized when marginal revenue is equal to marginal cost. That once again occurs at point D as we saw in the graph. Marginal revenue 1, marginal cost is 1. The monopolist then uses to determine the output level, in which case this is going to be 3 units of electricity in terms of kilowatt hours, in which they use 45% of their labor force. And since they are a price maker and they use the market demand curve for the pricing decision, when households demand 3 units of electricity in terms of kilowatt hours, at the corresponding price point is how they will price their goods and services, where on the market demand curve, when households are demanding 3 units of electricity in kilowatt hours, it will be so at the price point of 3. So then the monopolist is charging a price point of $3 as a result. So then overall what we saw then is that profits are maximized when marginal revenue is equal to marginal cost. The monopolist will use the marginal revenue equal to marginal cost condition to determine the output quantity, from which they will move up to the demand curve using that output level to find the price, since they are a price maker. Where here we have our profit maximizing process as well as our production function, where we said that our profit maximizing bundle was at point D, in which there's 3 units of output, which corresponds to using 45% of our labor force, so that's where it is on the production function. Where in terms of our profit maximizing bundle, producing 3 units of output at 45% of our labor force is when marginal revenue is equal to marginal cost. We then use this output level to move our way up to the market demand curve and figure out a price point, where in this case this also means $3. So then our overall profit maximizing bundle, to reiterate, is firm uses 45% of its labor force to produce 3 kilowatt hours of electricity that it charges a price point of $3 for, or in terms of calculating profits then, total revenue is going to be the price point of $3 scaled by our output level of 3, giving us $9, minus our fixed cost of 25 cents, minus our variable cost of 45% of our labor force being used, scaled by the wage rate of $5, where taking the difference between total revenue minus variable costs, and fixed costs, this then gives us a profit level of $6.50. Then lastly, to recap the profit maximization process for a monopolist, we have that the monopolist is a price maker due to market power. They face a downward sloping market demand curve in terms of their pricing decision due to their price making behavior and being the sole firm in the space. And as a result, they have a downward sloping marginal revenue curve that's below the market demand curve. They maximize profits when marginal revenue is equal to marginal cost, in which they use this condition to find the quantity level, from which they use that quantity level on the market demand curve in order to find their price point.